All right, ladies and gentlemen, we'll start our next panel. Now, this panel is a little interesting. It's a combination of different type of companies, but it's alternative investments. And a couple of the issuers here, they're actually only deal with high net worth investors, credit investors. So they'll probably talk about it in their workshops as well. So we'll start off to introduce everyone. So obviously to my immediate left, I have Jennifer Jackson. She is the president and COO of Solar Income Fund, a group based out of Toronto. I have Michael Cook. He is a director for EcoCapita and EnerCapita. I have the CEO of D2 Management and Daryl Osachuk. And the furthest gentleman is president and CEO of Arlington Street Investments, Frank Lonardelli. Welcome, gentlemen and lady. Okay, yes, spontaneous burst of indifference. So we have to get things going here. Yes, they're very nervous people. You can tell these guys are very shy, so please allow them a chance to impress you. First thing we want to start off is this. We have actually, the question I want to ask is for Michael and Frank. You guys are predominantly EnerCapita. I think they would have to do something with energy. Frank, you were in Calgary real estate. If you read the Toronto Star, a.k.a. the Red Star, and the Globe and Mail, they say that Alberta is just It's dying. It's scary. Who would want to invest there? So, gentlemen, maybe just start off with you two asking that question about what do you think about energy and real estate and potentially the Calgary area?
I'll start. So, for those of you that don't know, one of our funds is an energy fund. So we are closely watching what happens in commodity pricing. But our view is that there's always two sides to every coin. So on one side of the coin, you have crisis and challenge and turmoil. And on the other side of the coin, what you have is opportunity. And we see nothing but opportunity out there. Even if you just try and draw the parallel from investing at the peak versus in the valley, we see things that whether we're at the bottom of the valley or somewhere near, there's nothing but opportunity in the energy space now for those with a strong, long outlook, strong balance sheet, and good management team.
So a couple of things. I don't think there's anything new here. I want to kind of maybe defer from the balance of what's been said already. I think that everything that's happening today has happened throughout history. But there is one significant thing that's changed, and there's three factors. One, the internet, two, social media, and three, globalization. So I think the new norm for not just the stock market, but for society is in fact volatility. So if I'm right, and I think I am, then my recommendation is, what do you do about it? And the question about what you do about it is important. I think what you should do is three things. Number one, you should be investing in macro trends or macro markets, real estate, energy, finance. And I think you need to be dealing with management teams that have the appropriate capitalization, pedigree, and long-term track record, because that equation beats any market, up, down, volatile, flat. The opposite of that equation is reacting to the market on a regular basis. Now, there's only one thing that happens if you react to the market on a regular basis, and it's what we call analysis paralysis. And there's two things that happen with analysis paralysis. Number one, you have a coronary event, heart attack or a stroke. Or number two, if you have a bad enough case of analysis paralysis, you're going to walk yourself up a very tall building, or maybe you take the elevator, you're going to get to the roof and you're going to pitch yourself off. Okay, preferably not one of our buildings. We try to create some levity here today, Craig. So the news here, everybody, is that keep your feet on the ground, do be aware of all of the data, but keep your eyes on the horizon, because the winners have the appropriate perspective, and the appropriate perspective is the entire picture, not just today.
Thank you. Daryl and Jennifer, the recession, low oil prices, is that good or bad for your market? Let's start with you, Jennifer.
Well, I think the nice thing about being in renewable energy is that the oil price and the recession hasn't really touched us that much. Our business model is about a long-term energy contract with a government counterparty. And so when you've got a contract to produce energy for 20 years, you know your costs are fixed, you know what your operations look like, you know what your regular costs are going forward, it makes things very predictable. And so we're very lucky in that way, as we really do remain quite isolated as an investment class.
Great. Thank you. Daryl.
Thanks, Craig. I guess the biggest part of our thing is we like to look at ourselves as recession-proof. The biggest thing with us is it doesn't matter if the market's up, down, or around. We just kind of keep going with the flow, the good, the bad, and the ugly.
Okay. And what, and how?
Oh, you want to know how? All right, and how is basically, you know what, we're one of those, we target a market that's basically the underbanked, and with the part of the underbanked that we target is anybody with not bank accounts or who may have 1 or 2 bank accounts that would use payday loan stores and stuff like that. So it comes down to the fact that everybody's going to need at some point in time who, you know, may lose a job, and with the current situation that there is out there, there's a lot of people losing jobs.
Okay, and again, gentlemen, so he doesn't have 10 minutes to talk about it. He's got 20 minutes right after this to talk about obviously what you do in the U.S. market and how you're dealing with, believe it or not, 10% of the American population do not have bank accounts.
20%.
20%? There you go. Okay, I was corrected. Specific question to you, Jennifer. What makes so I guess overall for us, because we're talking about here's a bunch of people coming out, spending their weekends, spending actually money to learn about how to invest. What makes our category cool? And why do you think investors are moving into private and alternative markets from the public markets?
Well, I think the thing that is most interesting about this space is that you get to participate in a journey. That the one thing I loved about the exempt market and private equity is that we could start as a small company with a really good idea and a great business model. And it allowed us to pick up investors on a gradual basis, to be able to prove that the model works, to be able to show that we can execute and do what we say we're going to do, and then do it again, and get a little bit bigger next time, and get a little bit bigger next time. And so now we're on our 6th variation of the investment model, and we know what we're doing, and now we're really good at it, and our investors get to continue that journey with us until we get to the point where we're exiting, or we've gotten to the end state, where we've gone public, where we've sold ourselves off in a very profitable exit strategy. So, but it's being able to start in that beginning and then continue on that journey that I think was the most interesting aspect, because you can't do that anywhere else.
Great. How many of you, by the way, live in Calgary or Southern Alberta, like Lethbridge? Could I just have a hands just to see who's there? Look at all those Flames fans. Okay. Basically, one thing, and again, if you go to Jennifer's presentation, their business is based on a PPA, which is a power purchase agreement. When I was in Calgary, NMAX built their business, which is the energy provider, on a long-term 20-year PPA, power purchase, getting guaranteed price energy and selling it for way higher. So that's something that I'm sure Jennifer will talk about in her presentation, her workshop.
Craig, can I just quickly add to just to add to Jennifer's point? I think what is particularly cool about this marketplace is just illustrated and demonstrated with you folks here today. It's not often you get the opportunity to come by a booth and meet the principals or the founders and talk to them and really get a sense for, you know, after a conversation with, you know, with Frank, for example, you get to say, you know, he seems like a really solid guy, smart, he's dialed in. And that's the kind of guy I want to be making investment decisions on my behalf. That's the kind of guy I want on my team. And that's unusual and unique in this marketplace, which I think is what makes it cool.
Great, great. Daryl, you're looking cool dressed like that. What do you have to say?
No, I'm just kind of chill, listening to the same thing. I agree. I mean, you know, the biggest part, I come out of the IROC world at one point in time, and the biggest thing there is that with this industry is that there's a big segment of, you're all asset-backed securities. You actually physically own something, right? In my opinion, in the public world, you own a dream, right? Here you actually physically own an asset, and that's what most of us at this table are, is that there's something behind what we're talking about.
Frank?
Yeah, I don't think I have a whole heck of a lot more to add to that. I think the key is, regardless of whether it's a public or private asset, you're investing in the same thing. I think there's 3 key rules to investing into any company at any given time. And it's a little bit different than maybe what we'll talk about. Maybe you can ask me on the follow-up question, but I think there's opportunities in every market. Certainly what Mike talked about is important. There's nothing like standing up in front of a CEO, shaking his or her hand, because as human beings, we're all human lie detectors, right? There's not a lot of opportunities for you to go sit up with the CEO of a major publicly traded company that's got a 4, 5, 7, 12, $50 billion market cap and say, hey, so tell me about you. What have you done? What's your past? And what keeps you up at night? So I think that's certainly one of the benefits.
Okay, thank you. Mike, you're a CA. So what should investors focus on when they use the word assessing risk? Because risk can mean many things. So perhaps maybe take through a CA's mind when you assess risk.
Yeah, not to emphasize too much from the CA perspective, but I think to maybe follow on Frank's thought that, you know, there's maybe 3 key factors that we look at when you're looking at any investment. That is, first and foremost, we believe to be, you know, what's the management? What's their story? What's their track record? What's their motivation? Secondly, I think it really boils down to what is the financial condition of the business? What does the balance sheet look like? What's the amount of debt exposure that you have on the balance sheet? And thirdly, with every investment that's out there comes an element of risk. In fact, the risk-reward trade-off is crucial for any investment. And really, you got to ask yourself, when you're looking at any of these investments, what is the strategy that management employs to mitigate that risk, to deal with those risks and minimize them on your behalf as investors? So I think those are three key points. And then, the one that's sort of overriding it all is, are we in the same boat as management? Are we aligned from the perspective of, as investors, do we get paid first or do we get paid second? And I think that, you want to make sure that you're looking at an investment where, everyone gets paid according to the capital that they put in. For our funds, investors put their capital in first, they get paid first, and then management gets paid. So I think those are, in my opinion, three ways plus an overriding rule on how to look at an investment.
Great, thank you. Daryl, your market, I don't know if you can explain in 30 seconds what it is, but how does the current economic conditions affect your business, and what's the opportunity?
30 seconds, all right, I'm going to go fast. Current economic conditions, the worse it gets, in all honesty, is the better it is for us, and you kind of hate to be the contrarian in the room, but you kind of are. We target the underbanked in the United States. Things have gotten worse since 2008. The government will tell you otherwise. You can watch it on CNBC and all that, and they say it's better. It has gotten better from an economic standpoint. The difference between the have and have-nots has gotten greater. We actually help the have-nots, and the key word is help the have-nots. We try to make it a better life for them, but we also profit doing it. So in a 30-second speech, that's what it is, and we'll tell the rest in the back room if you want to hear more.
Okay, great. Frank, you Italian, you're a mama's boy. So if your mother was sitting in this audience, what would you tell her, and what are the three most important things she should consider before investing?
Mama's boy. Well, mama's boy would never give my mother advice because I'm way more intelligent than that. So the backdrop to that is actually something fairly personal. So my mom was a widower with 4 kids by the time I was 3 years old. My mom actually never made more than $40,000 a year and probably retired wealthier than 90% of the people I know who make $1 million a year. And if she told me one thing, she'd tell me the same thing Warren Buffett told me, which is something that everyone has to remember, regardless of how impressive these conversations sound like. You should be investing into things that do not risk your original capital. Warren Buffett says, golden rule number 1, don't lose the money. Golden rule number 2, don't forget golden rule number 1. So if you're asking me my opinion, I can tell you there's 3 things I would tell everyone in this room, and it's how we built our company. Number 1, if at all, by the way, we built our company based on investing into other people's companies and having very bad results. Okay, so experience is an amazing thing. So number 1, if at all possible, do not buy, co-invest. Number 2, a past track record is a predictor of future performance. And number 3, find out who else is investing. So number 1, if at all possible, don't buy, co-invest. In our company, kind of like Mike's, we take the largest single position in every one of our projects. We also take the largest amount of risk in every project. Secondly, our clients get paid first, they get their capital return first, they get a preferred return, and they don't have any risk except for their original equity. Thirdly, we get paid last, and we take on all the debt risk. That is a business model that we refer to as a concentric model based on equilibrium. In other words, our values are directly aligned with the investor's values. They're in perfect balance. Number 2, a past track record is a good indicator of future performance. So if you're going to be investing, kind of like Mike talked about originally, go and talk to the CEO and ask questions about his winning track record. CEOs, males or females, ought to have gold medals. What have you done before? What's your track record? How long have you done that for? What have your returns been? And here's a great question. Have you ever lost money? If so, how, and how have you mitigated that within your business model? And last but not least, and I'm going to get a little flack for this because I was in the, we call it, in the public market, dumb money, smart money category, okay? We ask a simple question, and I would ask this simple question. Who else is invested? Don't you want to know that? Accredited investor, private equity, family offices, pension funds, institutional capital. There's a comment made about institutional capital in the earlier panel, and I would agree to most of that, but I would tell you this. Those companies are built to win. And so if you're going to be investing your capital, you should find out if any of the companies have that investment capital into theirs, because smart money leaves clues. All right? So number one, if at all possible, co-invest. Don't invest. Number two, a past track record is, in fact, a good predictor of future performance. And last but not least, find out who else is investing, because success leaves clues.
Great. Thank you. Mike, regarding Equicapita, we were here earlier, just Neil McIver and Michael Campbell was speaking about public companies trading at anywhere between 12 to 18 times earnings. What do you like about buying private companies in your model?
Well, there's so many things. I mean, and you can hear about it, shameless plug, in my session after this is done. And if I have any business owners, please join me back there. I think first and foremost, we really do love the business we're in. We really love working with business owners and their management teams, getting to know them, understanding the personality of those businesses, and understanding how we can carry that legacy forward. We are effectively a perpetual hold fund, so we're looking to buy great businesses and hold them forever. And we, on sort of the economic side, we differentiate from public market trading multiples because we're buying businesses at a fair price in sort of the 3.5 to 4.5 times range. So there's an opportunity for you as investors to make those upside returns just by virtue of the fact that there's a supply-demand imbalance in our marketplace, which gives us an opportunity to select only the best investments at a very reasonable price.
Great, thank you. Jennifer, when it comes to your business, what keeps you up at night? What worries you?
In all honesty, seagulls.
Okay.
I don't know if any of you have ever seen what a seagull can do to a solar panel, but it's pretty ugly. I think that's
we all hate seagulls.
Yeah, especially if you have solar
Except
panels.
if they're Seahawks, right?
Yes, yes. We have a pretty simple business model. At heart, I'm an asset manager. We buy installations, we develop the installations, we produce power, and it's really about taking care of those assets and making sure that they are performing at the most optimum level. We want to make sure that we're staying on top of the trends in terms of operations and maintenance, in terms of asset management. All of those things are really important. And I think when we look at what the risks are, we've really done a great job in locking down all the very predictable ones. We've got a 20-year contract to supply power at a fixed rate or a fixed price. That's pretty easy. We've got a fixed capital cost. That's pretty easy. So really the only variable for us, and we have long-term debt as well, over 18 years. So the only variable for us is what's going to go wrong in the meantime. So what's going to happen between year 1 and year 20? And that usually has something to do with seagulls, maybe a couple of mice that chew wires, but really learning the intricacies of your asset, understanding what can go wrong, what is your worst case scenario, how have you gotten creative when you have run into a problem to make sure that it's not going to happen again. And so we do a lot of work in terms of maximizing those assets and accounting for any of those problems, whether it's going to be an ice storm that's going to knock out your installation, or whether it's going to be a fire with a recombiner box. So, but that's really what we worry most about.
Great, thanks. Mike, you obviously buy businesses for a living. Not everyone is successful, but hopefully you can pick the good from the bad. So what keeps you up at night?
Well, we feel that there's really three important elements to our business. First and foremost is obviously making really solid long-term investment decisions with those decisions that we make for deploying our capital and buying good businesses. But second, that works with that is we need to continue to have an opportunity to work with our investor base and raise capital by continuing to engage in their trust and have them work with us. And then thirdly, we buy our businesses. As I mentioned, we're a perpetual hold fund. Once we make that decision to buy it, we've obviously gone through our whole process to ensure it's a good decision. But the game isn't over then. That's really when the game starts. So we work very closely with the management teams that run our businesses and make sure that we're continuing to execute on the business plan. So, it's a lot of moving balls and a lot of things that are sort of ongoing, and a business is a real live, living entity that we have to kind of work closely to make sure that it continually executes.
Great. One last question. Daryl, obviously you're investing in machines that require U.S. money. I've got Canadian money. How do I invest in U.S., and are you worried about the exchange rate and where it's going, or where it's going down or up?
The million-dollar loaded question. From our standpoint, we invest in U.S. dollars. We pay in U.S. dollars. I truly believe that the U.S. dollar will get stronger. Anytime you've seen moments of turbulence in the market, everybody seems to flee to the U.S., right, wrong, or indifferent. It happened back in 2008, and I truly believe it'll happen now. Actually, we're seeing it now. So from our perspective, the way we look at our investment is we've structured ourselves properly. People that invested with us early 2012 when the dollar was at par are way ahead of the game now as to even what we promised them. And at this point in time, we think we're in the exact same position.
Great, thanks. Okay, so ladies and gentlemen, that concludes the panel.